The alarm clock rings at 6 a.m. It is dark outside. The rain is hitting the window. For most people, this sound is the start of another grueling day in the rat race. The commute, the endless meetings, the boss, the stress. But for a 5-year-old man named Eduardo, this morning is different. Eduardo reaches over, turns off the alarm, and goes back to sleep. When he finally wakes up at 9 a.m., he makes a cup of coffee, opens his laptop, and smiles. While he was sleeping, 3 different companies deposited cash directly into his bank account. He didn't clock in. He didn't sell anything. He didn't answer a single email. Eduardo is completely, totally free. How did he do it? Did he win the lottery? Did he inherit a fortune? Ready to build your passive income fortress? Hit the subscribe button and let's rewrite your financial story. No, Eduardo simply understood the math of wealth, and he hired 3 invisible, relentless workers to replace his salary. Today, we are going to break down the exact blueprint of how a 5-year-old man took his life savings, escaped the corporate grind, and built a fortress of passive income. We are going to look at the exact 3 dividend ETFs he bought, their massive financial backing, their hidden costs, and how they performed through the chaos of 2020 to 2025. And most importantly, we will project exactly what this portfolio will look like by the year 2040. If you are tired of working for money, pay very close attention. It is time to learn how to make money work for you. Let's go back to the year 2020. Eduardo had just turned 39. He had been working in the corporate world for 2 decades. He lived below his means, drove an older car, and saved aggressively. Through sheer discipline, he had accumulated exactly $300,000 in cash. But Eduardo was exhausted. He felt like he was trading the best years of his life just to watch a number on a screen get bigger. He realized that a pile of cash is just a pile of paper. Because of the silent thief of inflation, that $300,000 was actually losing value every single day it sat in the bank. He didn't want a pile of cash. He wanted a cash machine. He wanted to achieve lean-fire financial independence and retiring early. He wanted enough passive income to cover his basic living expenses so he could finally own his time. So, Eduardo made a radical decision. He took his $300,000 and divided it into 3 equal parts. He took $100,000 and deployed it into 3 specific exchange-traded funds. He wasn't looking for the next trendy tech stock. He wanted boring, reliable, cash-flowing assets. He wanted the ultimate sleep-well-at-night portfolio. His first $100,000 went into the foundation of his fortress. Are you already investing in ETFs or just getting started? Drop your comment below so we can discuss it. VYM, the Vanguard High Dividend Yield ETF. Eduardo chose Vanguard because they are the undisputed kings of low-cost investing. VYM is a financial behemoth. It has an astounding assets under management, or AUM, of over $50 billion. When billionaires and massive pension funds trust a fund with $50 billion, you know it is built like a tank. VYM holds over 400 of the largest, most stable dividend-paying companies in America. We are talking about giants like JP Chase, ExxonMobil, and Procter & Gamble, the companies that sell the oil, the banking services, and the soap that the world needs every single day, no matter what the economy is doing. But the best part about VYM is the cost. Wall Street managers will typically charge you a 1% or 2% fee every year just to manage your money, and they will probably underperform the market. VYM has an expense ratio of just 0.06%. That means for Eduardo's $100,000 investment, Vanguard only charges him $60 a year to manage it. It is practically free. VYM was his anchor, providing a rock-solid dividend yield of around 3%. His second $100,000 went into the growth engine of his portfolio, SCHD, the Schwab U.S. Dividend Equity ETF. If VYM is the anchor, SCHD is the snowball. SCHD is famous in the investing community, and for good reason. It also boasts a massive AUM of over $55 billion and shares that same ridiculously low expense ratio of 0.06%. But SCHD has a secret weapon. It tracks the Dow Jones U.S. Dividend 100 Index. To even get inside this ETF, a company must have a track record of paying consecutive dividends for at least 10 straight years, and it must pass strict financial health tests. It holds champions like Home Depot, Coca-Cola, and Lockheed Martin. Eduardo didn't just buy SCHD for the 3.5% starting yield. He bought it for the dividend growth rate, Historically, the companies inside SCHD increased their dividend payouts by about 10% every single year. This means Eduardo's passive income would automatically grow faster than inflation, without him ever having to invest another dime. SCHD was his inflation shield. His final $100,000 went into the cash machine. JEPI, the JP Morgan Equity Premium Income ETF. Eduardo needed immediate cash flow to pay his monthly bills. VYM and SCHD are fantastic, but they only pay every 3 months. Eduardo's mortgage and grocery bills arrive every month. He needed a heavy hitter. Enter JEPI. Launched right in the middle of 2020, JEPI quickly became an absolute monster in the financial world, accumulating over $33 billion in AUM in record time. JEPI is different. It doesn't just hold stocks. The fund managers at JP Morgan also sell options contracts against the portfolio to generate massive amounts of premium income. Because this requires active management by Wall Street professionals, the expense ratio is slightly higher at 0.35%, costing Eduardo $350 a year for his $100,000 investment. But the trade-off is incredible. JEPI pays out its dividends every single month, and the yield is huge, historically hovering between 7% and 9%. This was the dopamine hit Eduardo needed. This was the fund that paid the electricity bill, the water bill, and the internet bill. So, the trap was set. It is 2020. Eduardo has deployed his $300,000. He quits his corporate job. Let's look at what happened over the next 5 years. From 2020 to 2025, this was not a calm period in history. We saw a global pandemic, massive supply chain shutdowns, a terrifying spike in inflation in 2022, and aggressive interest rate hikes by the Federal Reserve. A lot of investors panicked and sold everything. But Eduardo was sleeping. In 2022, when the tech-heavy Nasdaq crashed by over 30%, Eduardo's dividend portfolio acted like a bulletproof vest. Value stocks and dividend payers held their ground. His portfolio barely flinched. Let's look at the numbers. By the end of 2025, Eduardo's $100,000 in VYM had grown in capital appreciation to roughly $145,000, while paying him thousands in cash along the way. His $100,000 in SCHD, the growth engine, had exploded. It not only provided a growing stream of income, but the principal value soared to nearly $160,000. And his $100,000 in JEPI, while not growing much in share price, did exactly what it was designed to do. It pumped out high-yield cash every single month, delivering over $35, 0 inches pure dividends over those 5 years. Eduardo's initial average yield across the 3 funds was around 4.8%. On a $300,000 portfolio, that generated about $14,400 in passive income in year 1. It was tight, but it covered his basic lean fire lifestyle. But by 2025, because SCHD and VYM had increased their payouts, his yield on cost had grown. He was now making closer to $18,000 a year, completely passively. He supplemented his income by doing freelance consulting, only when he felt like it. He owned his time. But what happens next? What is the ultimate power of this strategy? Let's put the 8th wonder of the world to the test. And fast forward to the year 2040. Eduardo is now 60 years old. He has not worked a corporate job in 20 years. He has lived his life on his own terms. Let's assume Eduardo didn't reinvest his dividends. He spent them all to live. Even so, the underlying capital of SCHD and VYM naturally appreciates over time alongside the broader economy. Assuming a conservative historical capital appreciation of about 5% per year for the dividend growth funds, Eduardo's original $300,000 principal has naturally swelled to over $650,000. But here is the real magic. Remember SCHD's dividend growth? Because the companies inside the ETF increase their payouts every year, the actual cash hitting Eduardo's bank account has multiplied. By 2040, his portfolio is generating over $35,000 a year in pure passive income. His salary doubled, and he literally did nothing to earn the raise. If Eduardo had kept that $300,000 in a savings account back in 2020, inflation would have destroyed half of its purchasing power by 2040. He would have run out of money and been forced to go back to work in his late 50s. Instead, by trusting the trifecta of VYM, SCHD, and JEPI, his wealth grew, his income grew, and his stress disappeared. This is the reality of dividend investing. It is not a get-rich-quick scheme. You won't buy a Lamborghini next month. It requires discipline to save the capital and patience to let it grow. But it is the most reliable, mathematically proven way to buy back your life from the corporate machine. You are literally buying pieces of the global economy and demanding that they pay you a slice of their profits for the rest of your life. Eduardo's story is not a fairy tale. It is a mathematical blueprint. The AUM of these funds proves that millions of smart investors are doing this exact same thing. The low expense ratios prove that you don't need Wall Street to manage your money. You just need a strategy. If you want to stop trading your precious time for a paycheck, if you want to build a portfolio that pays you to sleep, then you need to master these concepts. Here at Eduardo Invests, we break down the exact strategies, the ETF analysis, and the mindset you need to achieve financial independence. Do not let another year go by watching your cash lose value in a bank. Hit that subscribe button, join the movement, and let's start building your dividend machine today. Ready to live off dividends? Click the next video to discover top dividend and growth ETFs right now.